Another important topic regarding partnership taxation is self-employment tax. Self-employment tax is basically it's FICA tax for self-employed people. Um, so the question is, what income is subject to self-employment tax or this FICA tax? And the answer is, in a partnership, if there are partners that receive guaranteed payments, then those guaranteed payments are subject to FICA tax or self-employment tax, just like wages would be, because guaranteed payments are basically wages to partners. They're not called wages; they're called guaranteed payments, but they're for services provided by the owner, by the partner. So the guaranteed payments are subject to self-employment tax, but also the end profits of the partnership are typically, whatever flows through from the partnership to the partner is usually subject to self-employment tax as well. So it's important to know that when you're looking through or answering questions about um, what are self-employment tax liabilities for certain partners associated with either guaranteed payments or the profits of the business. In this example here, they're talking about a $10,000 guaranteed payment. Should they classify it as self-employment income? The answer is yes. The law is clear about guaranteed payments, but also will they classify her share of the ordinary business loss or income, if it was income, as self-employment? And typically the answer is yes if the partner is materially participating, more than 500 hours, materially participating in the partnership's activities. And then there's some discussion here about allocation of partnerships income or loss items. So we're looking at this example. That's a good example to show you how special allocations would work. Partnerships are one of the only, LLCs too, are one of the only entities where you can allocate profits or gains and losses specifically to certain partners outside of the whatever profit sharing interest that they own. Like you can just have a separate agreement that says this 30% partner might receive 70% of the profits from this one activity. You can't do that with S corporations or other types of flow-through entities. So this is a good example of specially allocating income inside of a partnership scenario. And then finally, in this to finish up this learning objective, partnership compliance issues. That means partnership tax filing issues. We file Form 1065 for partnerships. That's the form you're going to be computing. That form includes a Schedule K, which shows all of the separately stated items of the partnership that have to be reported to all of the partners. Each partner gets a Schedule K1, which shows that partner's specific share of all the Schedule K items on it. So you can see then page 1 of a 1065 looks like this, with ordinary income being calculated on the first page. That's the stuff that can be split just solely according to the ownership percentages of the partners. But then Schedule K brings forward that ordinary income number and also adds all the separately stated items to it. And then you can see that in Schedule K1 that follows, the particular partner will get his or her share of all of these items on Schedule K. See, all these same line numbers are the same as the line numbers on Schedule K, and all of the amounts are, like this ordinary income, that's based on the 40% profit sharing. So that's 40% of line 1 on Schedule K. This guaranteed payment, that's not a percentage because that's an actual amount that was paid to this person, Sarah. Okay, but the qualified dividends, the capital gains, those are all allocated based on the ownership percentage. Share of debt comes down here, and so you're going to be computing these forms when you do your tax return.